If you think Social Security is just a retirement check you get at 65, you are not alone. But here is the truth. Most Americans misunderstand how Social Security really works, and that confusion can cost them thousands of dollars over their lifetime. You are watching Income for Seniors. This video is for educational and informational purposes only. It does not provide legal, financial, or tax advice. Social Security rules are complex and subject to change. Your personal situation may be different. Always consult the Social Security Administration or a qualified professional before making benefit decisions. Some people claim too early, some wait too long, and many never realize they qualify for benefits they never applied for. So in this video, I'm going to break Social Security down in plain English. No legal jargon, no confusing charts, just clear, honest information, so you understand how the system actually works in the United States. If you are planning to retire, already retired, disabled, or helping a parent, this video is for you. Social Security is one of the most important financial systems in the United States. It affects retirees, disabled individuals, widows, widowers, spouses, and even children in some cases. Yet despite how big it is, many people only start learning about it when they are a few months away from claiming benefits. By then, many options are already gone. Today, we are fixing that. Social Security is a federal program created by the U.S. government in 1935. Its main purpose is simple: to provide basic financial support to people when they can no longer earn a steady income. That includes retirement, disability, and survivors of deceased workers. It is not a welfare program, and it is not a personal savings account either. Social Security works more like a national insurance system. Every time you receive a paycheck, you pay into Social Security. This happens through payroll taxes. If you are an employee, 6.2% of your wages go towards Social Security. Your employer pays another 6.2% on your behalf. If you are self-employed, you pay both portions yourself, which equals 12.4%. That money does not go into a personal account with your name on it. Instead, it goes into a trust fund used to pay current beneficiaries. In simple words, today's workers fund today's retirees, and when you retire, future workers help fund your benefits. Social Security is not just one benefit, it includes several different programs. The four main types are retirement benefits, disability benefits, also called SSDI, Supplemental Security Income, known as SSI, and survivor and spousal benefits. Each one has different rules, and confusing them is one of the biggest mistakes people make. Retirement benefits are the most well-known part of Social Security. You earn eligibility by working and paying Social Security taxes. These are measured using something called work credits. In most cases, you need 40 credits to qualify. That equals about 10 years of work. Once you qualify, your benefit amount is based on three things: your lifetime earnings, the age you claim benefits, and your work history length. Your full retirement age is not the same for everyone. If you were born in 1960 or later, your full retirement age is 67. If you were born earlier, it may be between 65 and 66 and some months. Claiming at full retirement age means you receive 100% of your calculated benefit, but you are allowed to claim earlier or later. Age 62 is the earliest age you can claim retirement benefits. But claiming early comes with a permanent reduction. This reduction can be as much as 30%. That means smaller checks for the rest of your life. For some people, claiming early makes sense. For others, it can be a costly mistake. It depends on health, finances, and long-term plans. If you delay benefits past full retirement age, your benefit increases. This increase is called delayed retirement credits. Your check grows by about 8% per year, up until age 70. After age 70, there is no benefit to waiting longer. This strategy can result in significantly higher monthly payments, especially for higher earners. Social Security looks at your highest 35 years of earnings. If you worked fewer than 35 years, zeros are added for the missing years. That can lower your benefit. Your earnings are adjusted for inflation. Then an average is calculated. This average is used to determine your primary insurance amount. That number is then adjusted based on when you claim benefits. Many people continue working after claiming Social Security. If you are below full retirement age, there is an earnings limit. Earning above that limit can temporarily reduce your benefits. Once you reach full retirement age, there is no earnings limit. You can earn as much as you want without reducing your check. This is an important rule many people misunderstand. SSDI is for people who cannot work due to a serious medical condition. This condition must be expected to last at least 1 year or result in death. SSDI is not based on income. It is based on work history and medical eligibility. Approval can be difficult. Many applications are denied initially. Appeals are common and often successful with proper documentation. SSI is different from SSDI. SSI is a needs-based program for people with limited income and resources. It is funded by general tax revenue, not Social Security taxes. You do not need work credits to qualify. Eligibility depends on income, assets, age, disability status, and living situation. Spouses may qualify for benefits based on their partner's work record. This can be up to 50% of the spouse's full retirement age benefit. You do not need a long work history yourself to qualify. Divorced spouses may also qualify if the marriage lasted at least 10 years and certain conditions are met. When a worker dies, eligible family members may receive survivor benefits. This includes widows, widowers, minor children, and sometimes dependent parents. Survivor benefits follow different rules than retirement benefits. Claiming strategies here can significantly impact long-term income. Social Security benefits are adjusted annually for inflation. This is called a cost of living adjustment, or COLA. COLA helps benefits keep up with rising prices, but it doesn't always fully match real-world expenses. This is why planning matters. This is one of the most common questions. Social Security is not going bankrupt, but it does face long-term funding challenges. If no changes are made, future benefits may be reduced. That does not mean benefits disappear. It means reforms may occur. Understanding the system early helps protect your financial future. Most people rely on advice from friends, social media, or outdated information. Social Security rules change, and personal situations are different. There is no one-size-fits-all strategy. What works for one person could cost another thousands of dollars. Social Security is not meant to replace your entire income. It is designed to provide a foundation. The more you understand how it works, the better decisions you can make. And the earlier you learn, the more options you have. If this video helped you understand Social Security better, take a moment to like it. Subscribe Income for Seniors for more clear and honest explanations. And comment below, what age are you planning to claim Social Security benefits?